Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
All right, when we started at 11, we had about a 60-odd point cut. That's 70 now. So some more selling. Mid-cap index is down 0.4%. The Nifty Bank is down about 1.2% or so as we speak. So there is pressure and there is red on the screen. Ashwani Gujral is with us. Ashwani, thanks very much. You know, this kind of sort of takes off from where we left off on Friday. And you were saying that there could be some selling pressure, some profit booking in the broader space because of the rally, and some, I think we had a specific conversation about private sector corporate banks. I mean, ICICI and Axis more specifically. Coming true, your sense?
See, that was Friday, and the Bank Nifty is 550 points off from Friday's high. Plus, the Nifty is off about 150 points from Friday's high. Now, you know, Turkish news is in the price. Now, unless the entire global market gets captured in a contagion and, you know, things are just allowed to fall, I think just in the very, very near term, maybe intraday, the market is not showing follow through on the downside. It's very clear we haven't broken intraday lows. So this is a good time to, you know, get long on Nifty as well as Bank Nifty, and particularly because we remain in an uptrend. And if you see Dow futures right now, they were down 160. They are now down only 137. So, you know, in this sort of a market, it's very easy for any statement or anything to lead to, you know, sudden sharp short covering. So if you are short, I don't think this is a good time to remain short. I have taken long positions because risk reward is extremely good. The risk is today's low, and upside, if it starts, you know, short covering can easily create a 70-80 point Nifty rally, and maybe 150-200 on the Bank Nifty. So that way, I think second half is now interestingly poised because the shorts are there in the system, and probably they are not getting great follow through. Individual stocks, Tata Steel is a buy with a stop of 570, target of 595. LIC Housing is a buy with a stop of 545, target of 570. And Tech Mahindra is a buy with a stop of 660, target of 685.
Okay. So, Ashwini, would you have a call on a stock such as PFC? That stock is down around 3% today. It's already lost around 31% year to date. Technically at around 83 rupees, how does it look?
See, PFC is probably one of the worst financials. And generally, you know, today PSU financials aren't feeling too good. But I think if you want a PSU financial, there are better stocks like State Bank, BOB, etc. PFC, REC are getting off the radar. I think they are making fresh lows. So there is no value in looking at them.
Just a couple of more names. Bajaj Electric, if you could look at it, 6.5 lower. There is Sobha, which is down about 4.5–5%, and Sun TV, which is down about 6% or so.
See, Bajaj Electric, you know, consumer stock today, most mid caps are lower. So that way, you know, 200-day moving average is 540. So it can still be bought. Keep that as a stop. Sobha, again, the uptrend is intact. So today's, you know, 5–6% falls, even if they are there, they are more in the tone of correction. So all sorts of, you know, consumer stocks, financials, wherever the trends have been strong, those are all, you know, buying candidates.
Okay. Before we get to the Twitter queries, Ashwini, what would you recommend on ICICI Bank? Because it started seeing that sort of up move that we've seen. It's up around, what, 6% odd month to date, but it's down today. So is today's weakness an opportunity according to you?
See, it was going up, you know, 5–6%. It's off like 1%. So if it gets to between, say, 305, 310, you know, you should be buying, because the rally which happened was so sharp that this sort of a correction gives you buying opportunities.
Okay. All right. So let's get to those Twitter queries then. We have Pavan, who has 100 shares of Voltas, Ashwini, at 655. He wants to know the future of the stock.
See, the problem here is that, if you are getting a decline and Voltas decline to 520, you should add on. In a company like Voltas, you can do that. It's not going out of business, Tata company, etc., etc. That would have lowered his acquisition price. But I still think 850 is possible. But just make sure that you buy after declines and maybe average if the company falls because of bad results, good monsoon, etc. So those are all buying opportunities on Voltas.
Okay, Ashwani, thanks very much. We speak again in about an hour. Appreciate you joining in with those trades, that advice, that commentary. 65 lower on the Nifty. Ashwani's basic point is the shots are already in. They're not getting follow through. So beware if you are looking at selling incrementally and thinking, well, this is all going down, and you'd make a quick buck. Well, it may not be a smooth ride in that sense. So that's where we are. Let's bring in Girish Pai, Head of Research with the Nirmal Bang Institutional Equities. He's joining us right now. Girish, good morning. Good to have you here. Let's just begin very quickly with what your thoughts are on HDFC Bank and the exit of Mr. Sutankar. The call this morning from Mr. Puri. As always, characteristically confident about prospects for the bank and saying no real impact on business, etc. It's all in a way taken care of. That's the message from Mr. Puri. But your sense from an investor point of view?
Yeah, so it's a small wrinkle right now. I think HDFC Bank has got a fairly deep management bench, and I think the exit of Mr. Sutankar is probably going to have a small negative impact in the short term. But beyond that, if you take a medium to longer term perspective, I think the company is well placed to benefit from the credit growth that's going to happen in the Indian economy. And I think once the economy picks up to 7.5% to 8% number, I think the credit growth will probably accelerate from here. So I think we have a buy on the stock with a target price of 2,500, and we stick to that despite whatever has happened recently in the bank.
Oh, okay. So no impact there, but in terms of a pecking order within the corporate banking space or the private financial space, what would it be, Girish?
Yeah, so from a tactical standpoint, we like corporate banks right now. While there is a structural play from the private retail-focused banks like HDFC, IndusInd, etc. From a near-term standpoint, we think that there is a fairly larger upside in the corporate banks, and we are talking specifically of private corporate banks. We're talking about ICICI Bank and Axis Bank right now, more so ICICI Bank, because I think a lot of the worries on the asset quality side are largely behind us. I think most of them have been recognized and largely provided for as of first quarter of FY19. From here on, I think the accretion is going to be fairly minimal. The other thing that one needs to take into cognizance is the fact that the book of ICICI Bank has turned retail. So almost like 57–60% of the loan book of ICICI Bank is retail as we speak. Plus, there's a fair bit of value coming from the subsidiaries, which are into asset management, life insurance, general insurance and stuff. And these are leaders in their businesses. So to that extent, we like ICICI Bank quite a lot. We have a target price of about 415 right now. So within the pecking order from a 6 to 12 month perspective, we would probably want to pick ICICI Bank and then go down to maybe look at the structural plays like HDFC and HDFC Bank and IndusInd Bank.
Girish, that's on the banking space. One stock I wanted to ask you about is Tata Motors. I mean, there's a report which says that the valuations or the cheap multiples seem to be just a value trap. And that has been the argument for many, many people to actually accumulate Tata Motors or recommend it as well. What's your sense, considering the kind of weakness and continuous kind of weakness that we've seen, say, in terms of the fundamentals as well as reflecting on the stock price?
Tata Motors is not under our official coverage right now, but I think the big problem with Tata Motors is that a large part of its profits comes from JLR, which seems to be facing weak sales growth globally, particularly in China. So to that extent, I mean, I wouldn't be able to give a specific comment on it, but within the large cap auto space, we like Maruti as well as Eicher Motors, and within the two, we like Eicher Motors a little bit more. So Maruti, it's a case of a company gaining market share with regular introductions of new products. So we think that situation is going to continue even going forward. I think between the two, that is between Eicher and Maruti, we like Eicher a little bit more because we think that over the next 3 to 5 year time frame, we think that Eicher's volume growth is going to be a tad faster than Maruti's. We think that it's going to gain market share within the overall motorcycle space. Currently, it's got a motorcycle market share of about 5 to 6%. But one should look, if you look at a geographic standpoint, in the more prosperous states like Punjab, Kerala or Goa, almost 1 in 3 motorcycles sold are from Eicher. Whereas if you look at the poorer states, I mean the states which are lower rung, say UP or Bihar, you have just the market share there at about 1 or 2%. So I think my sense is that as India becomes more prosperous, my sense is that the motorcycle buyers will gravitate towards the Eicher products, and that will mean that you will actually see market share gain driven growth in Eicher. So we are expecting a low teen to high teen kind of, mid-teen kind of growth come through for Eicher in the medium term, which should be better than that of Maruti's over that particular time frame. So while we like both companies, we would kind of rather bet on Eicher Motors at this point in time.
Girish, just wanted your feedback from all your conversations with the buy side. I mean, what is the mood out there really like? I mean, are people excited, saying, well, growth is picking up, earnings revival is on track, a lot more opportunities will come our way? Or there is a sense of skepticism with regards to the very high valuations, especially in large caps?
So I think the problem that the domestic fund managers face is that they are getting in money, and it's a question of how do they allocate that capital within the set of stocks that they have, the stock they're supposed to consider. Now with the reclassification that has been ordered by SEBI, you have a situation where within the top 100 market cap companies, you need to fill your portfolio, especially the large cap funds, those companies. So right now the hunt that most of these fund managers are on is with respect to where can you get the best returns within these large cap companies. So it's more of a process of finding where the maximum return can be generated. So I think that is the view that we have coming out of the buy side right now. It's more, I think the situation vis-a-vis flows still remains fairly good. We still have about $1 billion of SIP flows coming through on a monthly basis, which is obviously there is an issue with lump sum amounts not being up to what the numbers were, say, in November, December, January of last year as well as this year. But I think the SIP flows are still fairly strong, and when you compare that with what we had, say, 2 years back, the situation still looks good. So even now, as we speak, it's still a situation where fund managers are looking for good ideas to invest in.
Well, you're still tuned into Trading Hour. There's some news coming in on Amara Raja, where the first phase of a greenfield automotive battery unit has, I think, been commissioned. They're going to set it up with an investment of around 700 odd crores. So that stock is just about reacting a bit to that piece of news. Bharat Forge is another stock which is down around 3 odd % at this point. So to watch out for that. And even something like an e-clerks, low volumes on it though, but that stock down around 3 odd %. Venky's too, which is sulking a little bit, just about closing in on its 200-day moving average. But let's talk about a couple of numbers then. Titagarh reported Q1 numbers, and to discuss the performance, we have with us Anil Kumar Agarwal, the CFO of the company, who's joining in. Mr. Agarwal, thanks very much for joining in. Well, it was positive revenue and operating profit growth, but the finance costs are up sharply. Can you explain why?
So basically, this is the first time Railway has done away with the concept of the free supply item. Earlier, Railway used to give a lot of items as free supply, particularly wheel set, steel and the bearing. But now, since the wagon builders has to procure these items of their own, so there is a huge requirement of working capital, which has resulted in increase in the overall finance cost.
Okay, so given the change in the tendering terms, did you work in the higher working capital cost into your pricing?
Yeah, that's correct. So when we participated in the tender, it was known that yes, the railway is going to do away with the free supply, and the additional interest cost or the additional financial cost was taken into the consideration.
Right. So margins in the wagon business was down sharply. Can you tell us why? What happened?
Yeah, it's the wagon and coaches. The profitability completely depends on the product mix type. So suppose if we are executing large part of the coaches side, then the margins are totally different as compared to the wagon business. And even in the wagon business, between the private customer and the Indian Railway, the margins are totally different. So in this first quarter, the major execution was the Indian Railway wagon orders, whereas in the previous quarter or the year-to-year last quarter, the execution was primarily of the coaches side. So that is the reason for the variance. But going forward, even when both the coaches segment as well as the execution of the private customer starts, then the margins should improve.
So could you give us a sense of the order outlook across, I mean, say for example, the government sector, the private sector and the international business? How is this likely to pan out?
Yeah, so today we have the order book of around 2700 crore, out of which around 1400 crore is from the Indian operation and around 1300 crore is from the overseas operation. Now going forward about the various opportunity in the Indian market, you know, there is already a tender floated by the Indian Railway for 22,000 wagons, which is going to be opened by end of this month. And you know, going by the past trend, company expect a large quantity out of that. Similarly, the new products like the metro business, there are two tenders. One is of the Mumbai Metro, another is of the Pune Metro, which the company is targeting. And these are large orders. Similarly, in the shipbuilding also, there are various opportunities.
Can you give us an idea of the upcoming metro tenders and the likely margins there?
So again, you know, going forward with the increase in the volume, the margins are going to improve. And as I said, you know, the more we execute of the passenger coaches side, the overall margin will improve. So in terms of the new orders, again, you know, the pricings are not yet decided, and it would be very difficult on my part to comment anything on the margin. But you know, in a Indian Railway wagon tender, I think it would be more or less in line with the past trends. But in terms of the metro business, again, you know, it would be a completely new entry for us, and it is very difficult to predict the margin right now. But we would definitely like to be very competitive to enter into this market.
Are you seeing a pickup in private orders?
Like the one metro, the one metro tender which is due this month is of the Mumbai Metro, which would be around 5,000 odd crore, and another tender of the Pune Metro, it should be around 1,000 to 1,200 odd crore.
Okay, are you starting to see a change in the mix? Could you tell us what your current order book split right now is, again, between government, private and international?
So again, you know, in terms of the Indian order book, particularly on a Titagarh standalone basis, we have roughly around 850-100 crore order book, out of which the wagon business is around 500, and in that 500, the Indian Railway is around 250 and the balance is of the private customer. So it's a 50-50 between the Indian Railway and the private, and the balance order book comes from the different verticals, including shipbuilding, defense, passenger coaches, train electricals and all that.
I mean, you were talking about your French and Italian arms units. Could you tell us the size of the upcoming tenders which these subsidiaries will be able to participate in? Just talk about that a little bit.
In terms of the overseas operation, in our French company, we have an order book of around 40 million euro, which is completely of the wagon business. And in terms of Italian company, we have an order book of around 130 million euro, which is completely the passenger side. And in both the companies, both in the Italian companies as well as the French company, we have submitted various tenders which are yet to be decided, and hopefully the results of it should be out by 30th of September or maybe 31st of October. Then we will have a clear visibility in terms of, you know, higher order book and all that.
Can you share the capital employed and the ROCE for your French and Italian arms?
As far as the French company is concerned, the size is very, very small, like it ranges between 15 to 20 million euro per contract. But in case of the Italian company, the minimum size of the tender is generally 150 million euro.
So 70 points out of on the Nifty. Earnings season is still underway, and we've got Tata Steel we deal with today. Nigel is here as always with what the expectation really is from the company. Nigel, over to you.
Well, in terms of Tata Steel, let me run you through the key expectations first and what are the consolidated numbers you're looking at. Top line growth of around 21%, margins at around 19% odd, and net profit number of around 2,500 crores. Now, I'll tell you what, these are the least important numbers. For Tata Steel, you're looking at the geographic breakup. So let's start off with the India operations. Remember, we already have the sales volumes with us, the provisional number. So that's coming high by around 8% for the India operations. But importantly, the street looks at the EBITDA per ton. Our pull through up a number of around 17,500 rupees per ton. That's in terms of Tata Steel's domestic EBITDA per ton. What helps them out here? You have operating leverage playing out because of higher sales volumes. Remember, realizations as well have jumped up on a year-on-year basis. And Tata Steel, they have been focusing on value-added products, be it the automotive segment or even the branded products segment. In terms of their domestic operations, remember, they are partly integrated. So close to around 40% of their coking coal requirement comes in from captive sources, while in terms of iron ore, they're virtually, totally integrated. But moving to the European operations, well, on a year-on-year basis, we could see some compression in terms of an EBITDA per ton. We're working with a number of around $70 on a per ton basis. Sales volumes, they're more or less flattish at around 2.43 million tons. What doesn't really work in their favor? Steel spreads. That's the difference between your selling price and your input cost. That is expected to get compressed a tad bit, and we'll have to see whether or not they had some high cost coking coal inventory that could reflect in this first quarter. Southeast Asia, we already have the sales volumes numbers. That's coming at around 600,000 out.
Okay, all right, Nigel. Thanks very much for that. So that's on Tata Steel. Just look out for those numbers on automotive axles. But before that, there's some important exclusive news that we're getting you. The Parle G that you eat at tea time and maybe all the time could get more expensive soon. After Britannia recently indicated a possible price hike of 3 to 4% in the biscuits category, we learned that the maker of the iconic Parle G biscuits could be contemplating the same. Parle Products has finalized price hikes in the biscuits category owing to the MSP hike. Priya Sheth has this exclusive detail.
Well, this pack of Parle G that I'm holding up in my hand contains anywhere between 15 to 16 biscuits. 2 months later, this pack could contain anywhere between 12 to 14 biscuits. Now, let me tell you why. With an increase as far as input costs are concerned of wheat flour as well as sugar, as well as a steep hike as far as MSP is concerned, we do understand that biscuit makers are looking at going ahead and increasing prices for several of the biscuits across their portfolio. Now, what we do understand is Parle Products, which manufactures the popular brand Parle G, may look at going ahead with a price increase of about 8 to 10% for its mass brands. These include the likes of Parle G, Crack Jack as well as Monaco. And if you look at the premium brands, which include Milano, Hide and Seek cream and biscuits as well as several others in their portfolio, the price hike could be in the range of about 5 to 7%. Now, what we're talking about is not price hikes in absolute terms, but we're talking about reduced grammage across the packs. Now, for instance, a version of Parle G, which costs the cheapest version, which is about 2 rupees, could see a reduction in the number of biscuits from 8 to 6 is what we do understand from our sources. These new packs with revised grammages could hit the market anywhere between October and November, and that's a space that we will continue to track. But of course, with Parle Products going ahead and increasing prices going forward, it could perhaps set the ball rolling for several of the other smaller biscuit manufacturers as well. In fact, we did reach out to Parle Products with our query, and the company has confirmed that price increases are inevitable owing to the increase in input costs like wheat flour as well as sugar.